Okay, welcome all to 2011 Zaleski lecture. My name is GRZEGORZ EKIERT. I'm professor of government and research associate of the Center for European Studies. And it's my really great personal pleasure and honor to welcome MAREK BELKA to Harvard and to Center for European Studies. This place has been the major site of research and teaching on Europe for the last 3 decades, and the generation of scholars and experts on European politics in one time or another were part of that center, and part of why this center is such an important place is because of the visitors like MAREK BELKA. This is a Zaleski lecture, and Zaleski lecture was established by bequest of the Zaleski family to make Polish history and politics the present and integral part of intellectual life at Harvard. And I would like to thank Mrs. Marlina Weintraub for supporting us and supporting Polish affairs at this university. August Zaleski was an economist, politician, and diplomat. He was twice the Minister of Foreign Affairs of Poland and was the President of Poland in the Polish government in exile after 1947. And our recent speakers, which include Radosław Sikorski, Leszek Balcerowicz, and MAREK BELKA, in one way or another share something in common with August Zaleski. So we are really very happy that we have Polish visitors who really represent the best of Poland. Now, MAREK BELKA is currently the governor of the Polish Central Bank, but before he entered politics, he was the professor of economics at the University of Łódź and in the Polish Academy of Sciences, specializing in publishing widely about theory of money and anti-inflation policy in developing countries. So that fits his current position very well. Since 1990s, he held a number of important positions, both in Poland and abroad. So he was twice the Deputy Prime Minister and Minister of Finance of Poland. He was the Prime Minister of Poland in 2004 and 2005. And then he headed the United Nations Economic Commission on Europe and was the director of the Department of the International Monetary Fund. He also served in Iraq as the chairman of the Council for International Coordination after the war. And the rumor has it that MAREK BELKA was a top candidate for the directorship of the IMF last year. Now, for the last couple of weeks, I worried that Greece may collapse and he will have to cancel a visit to Harvard. But fortunately, the Greeks keep holding on and allowing us to have the pleasure of the visit of Professor BELKA. Now, the talk he's going to present is about European dimension of the global financial crisis, and we probably couldn't imagine the better timing for that lecture. Thank you very much for coming, and the floor is yours.
Okay, I understand that even if this is a series of lectures focused on Poland and Polish history and contemporary times, I think that what really interests people more than Poland is the situation in Europe at large. And that is why I chose to have a presentation that will try to cover many topics. I will start with a few remarks on my take of the crisis that we are going through, say something about the European characteristics or European specifics of the crisis, and then on this background say something about the region, the Central and Eastern Europe, and about Poland itself. And I hope that we'll have enough time to take some of your questions, which is usually the most interesting part of such encounter like this. Well, the first question is, why is Europe at the center of the global crisis? And with further ado, I try to hit the core of the issue, which is the euro. And don't take me wrong, I'm not Eurosceptic. I'm Euro enthusiast, rather. I have never been against the Polish accession to the Eurozone, even if now, of course, this is not an issue. And this is not to understand that without euro, the European economy would not be suffering from different consequences of the global financial crisis. Just imagine the situation in which all national currencies, especially of those countries that are performing poorly, like say Italy or Portugal or others, Greece, of course, what would have happened to those currencies? There would be currency crises in different European countries. But the fact that euro is a common currency for 17 of the European countries is, on the one hand, a shield protecting many domestic currencies or potential domestic currencies from clash, from crisis. But at the same time, the fact that the currency was introduced without necessary institutional surroundings caused the global crisis to develop in Europe into something much more serious and much more difficult to resolve. The currency turned out to be an unfinished project, or some people said that this is a project for good weather, for good times, or for gentlemen. And as you know, when national interests come into play, there are no gentlemen. So the common currency turned out to be, as I said, unfinished project. Well, let's now start with the crisis as a whole. As I say, the crisis didn't start in Europe. It started somewhere between Wall Street and the City of London, as I say, which is to understand that the core or the origins of the crisis are in the financial sector, in the banking sector, most probably. What are its causes? And there are different explanations, and many of those explanations are not mutually exclusive. On the contrary, they show different dimensions of global imbalances that brought the global currency, global economy to the crisis. So, global imbalances. U.S., China, of course. You know, one country is saving, the other country is consuming. It cannot go forever. Loose monetary policy. There is this strain of discussion exemplified, for example, by by Professor John Taylor of Stanford, prominent economist. But I'm sure that this is also a view very sort of well known to Harvard economists, that loose monetary policy. Too loose monetary policy was at the source of the crisis. Greenspan, basically, is the culprit, according to this opinion. Some people point to light touch banking regulation that was prevalent in the last 2 decades. The banking sector was liberalized, was deregulated in the 80s, basically, and the regulatory and supervisory framework was based on the assumption that the banks themselves can properly assess risk. And this was the basic assumption of the so-called Basel II regulatory framework. Those who are in the banking business or close to it know what it means. So light touch banking regulation. The banks can care for themselves was the basic assumption. There are many more explanations, but one that I would also add is the excessive growth of the financial sector. The share of financial sector in GDP of the US basically doubled, or more than doubled, in the last 2-3 decades. Very reluctantly, but some people say now, or start saying, that one of the things that should happen in the world is that the size of the financial sector should be reduced, which is something that obviously the financial sector people just hate to hear even. The trigger of the crisis was obviously the American housing market. It's something that does not need to be elaborated here. What was the mechanism of the crisis, of this trigger of the crisis? Well, banks reoriented towards mortgage lending. This is the easiest way to do business. I mean, mortgage credits are so simple, so unsophisticated that basically you can put a dummy in the bank branch and basically give him a simple scoring table, and if scoring is good enough, or even if it's not, the dummy gives or extends credit. And of course, the dummy is motivated to produce as much of credit as possible, because the bonus and the wage, basically, I mean, the income depends on it. So pervert internal incentive structure. Why was it possible in the banks? Well, there was technological change. I put it in quotation marks, innovation. Via securitization, those mortgage loans were sent off to the space, sort of sold off to some other entities. They disappeared from the balance sheet of the banks. And well, I remember I was being told 5 years ago by some enthusiastic people from the financial sector that basically securitization diminishes risks and allows the banks to develop infinitely, and basically it makes the whole system more stable. Well, I mean, for the people in the business, it's all well known. The problem is that these risks were not, I mean, they still existed, but they were transferred to people who are not fully aware of what kind of risk they were assuming. This was all fed by globalization, which in this respect meant easy access to foreign wholesale funding. So you had access to cheap money. Well, here a partial guilt of policymakers to lose monetary policy, you had innovation, which means you had an instrument to produce mortgages, reap the benefits, and send off risks to somewhere else. This was not regulated, as I say, light touch regulation and supervision, built on the belief that thanks to improved techniques of measuring risks, banks will be able to adjust their capital to potential losses. This is, in a pill, mechanism of the crisis. Well, when the crisis started, securities prices went down, balance sheet of the banks deteriorated, government intervention turned out to be necessary. So this is how the crisis evolved, first in the financial sector, and then the governments were pulled into this. Well, some people say it was wrong to do. I mean, the government should have allowed those institutions to fail. Well, let me remind you that one was allowed to fail. I mean, whether it was conscious decision of the American authorities, or it was just that they couldn't find a buyer for Lehman Brothers. I think that the second version is probably the right one. But then, as you might know, when it was clear to people like Hank Paulson, Bernanke, that the Lehman Brothers will go bankrupt, what they try to do is they try to find a buyer. Well, and the only buyer that was at hand seemed to be Barclays Bank in Britain. But the Brits said, no, we're not going to take the risk unless the state guarantees all the business, all the assets of Lehman Brothers. The American state was not ready. After all, free market is the rule of the game. So they stood, they resisted, and the resistance lasted another 5 days, not more, because then the second week it was AIG, a much more serious business that would go bust, and the authorities, the American authorities, decided not to take risk this time, and they guaranteed the buyout of AIG. Something like, altogether it was almost $200 billion, a trifle money for American taxpayer. So some people say, well, you should have allowed AIG to fail, but nobody wanted to take the risk of a total meltdown of the system, of the financial system. What about Europe? Well, the situation in Europe, the booms in Europe were a little bit different. No subprime mortgages, less innovation. But the euro, and here we come back to my first statement, the euro created an unsustainable process of convergence in the periphery of the European Union. The mechanism was feedback loop between inflationary pressures resulting from the booms and the fall in the real interest rates. Okay, now for the non-economists, what do I have in mind? Eurozone covers, what you can call core Europe, like Germany, France, Benelux, maybe Italy. And what was considered to be a periphery, Spain, Greece, Portugal, poor countries compared to the core, which embraced the euro, which meant that the monetary policy would be the same for all countries. For both say Germany, Netherlands, and Spain, Portugal. As a consequence, the inflation was higher in those poorer catching up economies. They started growing quite fast. Inflation was higher, but the interest rates were the same. So the real interest rates in those peripheral countries were much lower or even negative. If so, well, then the negative interest rates or very low interest rates precipitated a boom, which turned out to be unsustainable. The money flew in, but not to tradables, not to sectors that increased international competitiveness of those countries, but mostly to construction industry and real estate business. As a matter of fact, both in the West and in the East, both in Spain, Ireland, and in countries like Latvia or Bulgaria, the bulk of the growth, exorbitant growth, was in financial sector and real estate, something that you cannot easily export. Those lending booms produced inflation. Inflation led to erosion of competitiveness. In those periphery countries, wages grew fast, but then the potential export products of those countries became less and less competitive. No leaning against the wind policy. So, I mean, the central bank of Spain was not in charge of interest rates. They could not take the hit of the economy, cool down the economy, because the interest rates were common for the whole euro area and set in Frankfurt. So, lending booms, like in Spain, Ireland, export booms in Germany and Netherlands. Okay, not only in these two countries, but just to exemplify the mechanism. Lending booms led to acceleration, to upward tendency in the unit labor cost, ULC for non-economists, unit labor cost. It's ultimately what decides, what defines the international competitiveness of a country. In those exporting countries like Germany and Netherlands, ULC, unit labor costs went down. So the countries started to diverge rather than converge. So suddenly, because of the euro and because of the credit boom, because of the real estate boom, because of inflation, because of wage inflation, the countries like Spain and Ireland were constantly and consistently losing competitiveness, whereas the other group, the core, the northern core of European Union, were gaining in competitiveness. Let me add that Poland was not in the Eurozone, but it behaved more like Germany and Netherlands. As a matter of fact, the unit labor costs in Poland fell more than in Germany in the last decade. And this is basically one of the reasons why Poland withstood the crisis. Some people say, no, it was about fiscal profligacy, irresponsible behavior of countries that was at the core, at the source of the crisis. Well, in the case of Greece, true. But Greece is in a league of its own. When you look at other countries, the picture is mixed. Spain and Ireland had surpluses, budget surpluses. Not enough to compensate for private sector spending spree, but still surpluses. The SGP stands for Stability and Growth Pact. It's the internal European procedure to discipline the members of the European country, and here we talk about the Eurozone, by which the gentlemen were brought to reality, so to say. The European Commission if something went wrong with the budget policy, they initiated this excessive deficit procedure and told the countries to limit their budget deficit. But it didn't work. It was toothless. There were no sanctions. The markets were completely lulled by the common currency, and they couldn't of themselves, that is, distinguish the lending risk, the differing lending risk to different European countries. The cost of borrowing money on the market was almost the same for Germany and Greece. The economists use the expression that there was something which is called a halo of being a Eurozone country. The markets erroneously assume that even if a country, a Euro country, gets into trouble, it will be bailed out, even if the European Treaty of Maastricht, explicitly forbade any kind of bailout. But the markets didn't believe it. Well, what about Central and Eastern Europe? Well, on top of everything that you heard, there were two additional factors. Banking sector dominated by foreigners. This was one thing that happened at the beginning of transition, that domestic banking sectors, either created from scratch or on the ruins of the existing state banking, were sold or taken over by foreign banks. By the way, it served those countries quite well. Those foreign banks brought in capital, brought in expertise, and they behaved during the crisis, during the recent crisis. Not even one country suffered from a crisis that hit Thailand in 1997 or Mexico earlier, where the foreign banks just dropped the business and withdrew. It was not the case this time. None of the Central European countries went through a banking crisis. So, it's not a complaint. However, the however will come next. But then the foreign ownership made it much easier for lending booms in foreign currencies. Those Polish banks, which were subsidiaries, say for Polish banks or Hungarian banks or Latvian banks, that were subsidiaries of foreign banks, had very easy and apparently very stable access to foreign liquidity, cheap. Interest rates in Poland were, let's say, 5%. Interest rates in the Eurozone were, say, 3%. So the interest rate differential, and this differential is now even higher, prompted those banks to borrow money either from their parent banks or from on the interbank markets, so-called wholesale markets, cheaply, and re-lend those money to households and mainly households, but also to businesses at very attractive terms. Many Polish households took mortgage credits at very low interest rates, but those mortgages were denominated in either euro or, most popularly, in the Swiss francs. But it turned out to be a recipe for disaster, basically. Because when the crisis hit, especially now in this new phase of the crisis, some of those currencies appreciated. Swiss franc is a very good example. But also euro is not stable. Zloty weakened quite recently, in the recent few weeks, against the euro by more than, well, by almost 10%. No, by 10%. So this turned out to be quite risky. The borrowers were unhedged, basically unprepared to this new situation. And in Hungary, at least, it produced considerable problems for many households. Not so in Poland, but if there is interest, I'll explain a bit more after the actual presentation. So, what we learned about Western Europe held for Central Europe. On top of this, we had this banking sector dominated by foreigners and lending booms in foreign currencies. Everybody thought that Central Europe will be a deep, black hole of the European economy. I was at the IMF, and sort of I was, as I say, probably asked to lead the European department because they thought it's a Central European business, so let someone from that region do it for us, so to say. What happened is, of course, deep recession, with one exception, but the response was proper. Those countries hit by crisis adjusted their policies. They got financial assistance, so bridge financing from the European Union, from the IMF. And there was no banking crisis, no currency collapsed, with one possible exception being Ukraine. Ukrainian banking sector basically collapsed, but otherwise was nothing of that kind in the region. Now there is recovery. It is uneven, sometimes quite tepid, but the countries in the region proved economically and socially resistant. Now the problem for them is Western European neighborhood. It's where the instability comes from. The region is in reasonably good shape. Unfortunately, or maybe it's too much to say unfortunately, but the neighbors are in bad shape. Why Poland escaped recession? Well, we're slightly bigger than Czech Republic or Slovakia or Hungary. So when trade imploded in 2008-09, it hit Poland less than some of our neighbors. Export to Germany, which is quite important for Poland, is 10% of Polish GDP. And it's 23% of Czech GDP. So we are hit much less than some of our neighbors. Second, low aggregate debt. The size of the banking sector in Poland is much lower than in basically all other European Union countries. What does it mean, the size of the banking sector? Well, we measure it by the size of the balance sheet, consolidated balance sheet of the banking sector. And the balance sheet depends, the size of the balance sheet depends on the volume of debt, private debt, both household debt and corporate debt. And this is very, very low in Poland. Even if we, lament in Poland that the Polish households are more in debt and more in debt, and there are problems in servicing compared to most of our neighbors and all West European countries, and of course America. Polish households are basically not indebted. The Polish companies, Polish enterprises are even less indebted. I should say that it's primitive, but the Polish companies finance themselves out of internal resources. It is only possible because the rate of return on economic activity in Poland is much higher than in Europe generally, or in the world. I don't know about Asia. So simply the profits are much higher, and the companies can finance themselves out of internal resources, not using the bank. So when the crisis came, when the credit crunch ensued, when sort of credit became unstable and much more difficult to access, the Polish economy was hit, but also hit much less than the other economies. We were simply not leveraged, as they say in the contemporary parlance. Well, I would also add that macro and prudential policies were decent, so the country was in the position to let the automatic stabilizers, the budgetary automatic stabilizers, work and help the economy weather the crisis. So now let's turn back to Europe. We have, well, the topic of the day is sovereign crisis in Europe. I spent the last weekend in Washington at the annual meetings of the IMF and the World Bank, and of course everybody was discussing sovereign crisis, sovereign debt crisis. Well, but let me repeat what I have said before. Except for Greece, public debt was falling before the crisis. It was banks, not governments, that behaved irresponsibly. Of course, those countries which had more responsible fiscal policy, lower debt, are better off now and are in a position to get out of the crisis easier. But think of Ireland, one of the darlings of international economic community of the pre-war years. They had very low tax rates. The economy seemed to be very competitive, and the public debt was low. And then it turned out that it was the banks that behaved completely irresponsibly, and the Irish were maybe too fast to assume responsibilities for all those Irish banks, and instantaneously the public debt of Ireland crept up to something like 110% of GDP. Well, it was completely detached from the policies of sort of fiscal policies of Ireland. It's the banks. Recession and the need to bail out banks produced the crisis. Fiscal stimulus is also responsible, but really slightly. Maybe US is an exception, but I'm talking about Europe. So lessons to learn. Largely, prudent fiscal policy is not enough to keep the economy on a stable growth path. Why was the Eurozone unprepared? Well, first, no federal budget for the EU. Normally, when you have a currency, what do you have currency for? Well, to be able to borrow in that currency. One of the reasons you have a currency. But if you borrow in that currency, you have to have someone to guarantee the loans. If the Treasury, if the US Treasury borrows money on the market, it is you, American taxpayers, who guarantee those bonds, those borrowings. In Europe, we are not so sure who should guarantee this. We have no European taxpayer. We have German taxpayer, we have Dutch taxpayer, Greek taxpayer. It's 17 taxpayers, and it's not clear who guarantees the debt, Well, that's the problem. There is no federal budget because Europe is not a state. It's not a country. It's, well, we don't know what it is. No, don't laugh, don't laugh, don't laugh. I think that European Union is a fantastic thing, but it's in the making. And the crisis either will produce a collapse or a strengthening of the European Union. No bailout clause, I have mentioned this before, and belief shared by many non-Europeans that banking crises could occur only in emerging market economies. So I come back to this Basel II rules that basically rely that a crisis, my God, it's somewhere, you know, it's a Mexican phenomenon or Thai phenomenon, Polish phenomenon, but we are crisis-proof. Well, the last few years turned it upside down. In sum, EU had a common currency without fiscal backstop. It also completed full financial integration without proper regulatory and supervisory architecture. Okay, I'm coming to the end. Well, okay, where should we begin? There are some proposals. They are not equally sort of intensely discussed, but let me just go through some of the proposals. How to organize the Eurozone when the current one is resolved. I mean, so we are really talking about the future crisis, how to prevent any future crises in the Euro. Well, there was a proposal to create a European Monetary Fund, so something which smacked anti-Americanism, you know, European, not International Monetary Fund, which is supposed to be, of course, dominated by Americans. Now it's not en vogue anymore because we Europeans need the International Monetary Fund, need its money and its expertise. But something has been put in place in Europe, which is called the European Financial Stability Facility, which is a fund simply that could be transformed into something like European Monetary Fund or European Stabilization Fund. Okay, another big idea, issue Eurobonds. So let's now manage the debt of 17 countries together. Finance ourselves together. Well, but then the Germans say, okay, we have nothing against to finance ourselves maybe with the Austrians and the Dutch and some other good performing countries, but why should we borrow or rather sell our credibility to the markets for the benefit of others? Well, we should not be against it, but if provided the others meant their houses behave well, regain fiscal sustainability. But it will take years. And those bad performing countries should lose sovereignty over their own budget, which is probably the way it will go. This is really for economists. It includes something which is called collective action clause after 2013 to incentivize markets to assess sovereign risk properly. Okay, those who are not economists will not understand it. Those who are, let me just remind you that if a Mexico or a Poland wants to borrow money on the market, there is always something which is called collective action clause, which means if the country goes bankrupt, the creditors will participate in the burden of bailing out, which means that everybody looks carefully at the situation in the country borrowing or asking for a loan, and the markets weight the risk and demand higher reward for this, higher return. In the case of developed countries like the US, like Japan, or like Eurozone or European, Western Europe, there was no collective action clause at all. We cannot fail, of course. We are the adults, we are not children. We cannot fail. Well, not so. So as of 2013, there will be an explicit inclusion of this collective action clause into let's say, the borrowing agreement by the countries of the Eurozone, just to help the markets or remind the markets that no one is riskless, risk-free. Also, they want to introduce a new governance system in the Eurozone. Whatever it means, I will not elaborate on this. It all is about building up something of an European state. Which is fine. If you want to have a common currency, you have to have some attributes of a state. It's not possible, as the crisis shows, that you should have a common currency which is not backed, which is not supported by some solid institutions. These are some of the proposals that I will not elaborate it. Well, will it be enough? Well, why we refer to the Pisa Tower? It's a beautiful construction, but if you don't help, it will fall. So, what is the problem with the European, with Europe? We know how to protect ourselves, basically, protect ourselves from the future crises. We know that probably to keep the euro, which is a splendid thing otherwise, we have to strengthen the Eurozone. We have to build something of a state. Well, I fully understand. The more I am outside of the euro, the more I understand. But that to be in the euro means that you should become a member of something which comes closer to a political union. The problem is how to solve the current crisis. So, how to solve the problem of Greece, maybe Portugal, and this is about the short-term solutions. And this is something which is most difficult, and the options are discussed, but I will refer to the questions and answers session rather than continue this presentation. Thank you. Oh. This is something for experts. Central bankers notice. You can read it
Okay, thank you very much. Let me establish the ground rules for the question and answer session. So, if you could please identify yourself when you ask the question, and please keep the questions focused so we have more time for Professor Belka to respond. Also, I will take a few questions together, so then we'll give Professor Belka the chance not to respond to some questions he doesn't want to respond to. Okay? Okay, but the floor is open.
Well, first of all, thank you for splendid tour de zone. It answered my question I was going to answer. Does Europe need something like a state? You said yes. And then you raised at the end, essentially invited us to ask another question. What can be done in the current crisis?
My name is Elizabeth Mier. I'm a German reporter with the weekly paper Die Zeit, currently a fellow at the Center for European Studies here. I have two questions. One is, since you clearly put the blame more on the private sector than on the governments, what is the share you would expect from banks in the current situation? And is this handled well by European governments at the moment? And the second question goes a little away from what you talk about, but I would also be interested in your vision of where the global currencies might be in a time of 5 or 10 years. What is the perspective for the dollar and the yen? Do you think we will see something as a supremacy of the dollar again after this crisis, or what is your vision of what may be the next thing after that?
labor and work-life program here. My question is, I was pretty impressed by the decision by last week that you fought to against depreciation of zloty. But the question is, if Greece falls down within the next 2 or 3 months, clearly there's not much that could be done. And the question is, what are the possibilities for countries like Poland to fight against it? And of course, what are the prospects for Greece, in which, as you know, tax evasion is a national sport, and the only solutions you're trying to get is increased taxes?
Well, current crisis. I have been asked this question today twice at least. Can you hear me?
Yes.
But it's not through the mic. Okay.
This one is maybe, should I put this microphone?
I think it works. Yes. Does it work? Yeah, okay. Yeah. So I was asked this question at least twice today in different meetings. I'm always uneasy when I have to repeat what I have said before, but it's a little bit stupid to try to find out another sort of answer to such a pertinent and important question just within one day. So please, those of you who have heard me talk, bear with me for a moment. So, how to solve the current crisis? Well, first, everybody, at least on this side of Atlantic, tells us just let the country just default, which is you should do it in an orderly way, which is called debt restructuring, but this is the same for default. The country will never repay the debts because it's not growing first. But even if it were growing, the debt is unsustainable under any circumstances. I mean, it happened in the history of economy, global economy, dozens of times. And it happened in Poland in the early 90s. We were a bankrupt country. And we were granted 45% debt reduction. And it proved beneficial, not only for the country, but for the creditors, because they got the 45% instead of 0. So debt restructuring or default is nothing wrong. Nothing wrong. Nothing unusual. But so why is it not simply done? The answer is it may happen, but everybody in Europe is afraid of contagion. If it's done improperly, then the markets. Why would you do this in Europe? Well, basically for the sake of Greece, so that it can restart growing, which is not the only prerequisite for growth in Greece. Greece has to do much more to restart growing. It has to reform. Okay, I'm not going into details. But the other reason for Greece debt restructuring would be to stabilize the financial markets so that they behave in a sort of predictable, rational, forward-looking way, and not. We have basically a crisis on the European markets every week now, so that's unbearable, really. I mean, your question is very much to the point. So that restructuring for Greece would be to calm down the market and say, okay, now the situation is under control, and we can move on doing what it takes. For example, Italy should consolidate its finances, and so on and so on. But the fear is that the markets will not be calmed down by the Greek debt restructuring. Instead, they will say, okay, but this is not enough. You have to deal with Portugal also. So they will fall on Portugal like, a herd of wolves, pack of wolves, yeah? And attack Portugal. And then we do something for Portugal, and then God knows what happens next. So the fear that the politicians in Europe, or for example, Jean-Claude Trichet, has the contagion. The word is contagion. If you do this for Greece, why shouldn't you do it for another country? The second solution is to monetize the debt. Just let the ECB buy out all those papers and, just print the money for it. Why not? I mean, many countries have resorted to such. Inflation is the best way to get rid of the debt. I sometimes have the impression that this country is also seriously contemplating this solution. So why not? Well, again, the European Central Bank is against it because it says, well, but then the consequence of this is inflation. And some countries in Europe, like, for example, Germany, would say, no, but this is not what we have agreed to when we introduced the euro. We wanted European Central Bank to be like Bundesbank. And it's not exactly the same. So it's a bad solution. At least it is a solution that could unnerve the Germans and sort of make them basically leave the system. Okay, so what is the third solution? Because there are always three solutions. Yeah? Well, the third solution is some kind of muddling through. But muddling through is not a bad, I don't want to give it a bad connotation. Muddling through is really doing something on different fronts, using time, buying time and using time properly. What is the muddling through strategy that is currently pursued? Well, first, we put pressure on those culprit countries to do the job. So let the Greeks, make sacrifices, as the Latvians did, for example, as the Irish seemed to have made to a certain extent. So first, there is pressure on the countries, which is fair. Second, there is this EFSF idea, so a pot of money that is basically guaranteed by, so a pot of loans guaranteed by other countries. Well, this may or may not be a real expenditure, but of course it may be. So that the countries can be helped from this pot, as Greece is, as Ireland, Portugal is. Now the decision was that it should be beefed up and used also for two other purposes, not just a loan to a country in danger, in trouble, but also that this fund, led cautiously by a German, Klaus Regling, could be buying sovereign bonds on the secondary market. So basically releasing the debt burden from those countries. And also that part of this money could be used to recapitalize banks. Here we come to the second question, is the private sector involvement. The banks, so that they can take losses resulting from debt restructuring, debt forgiveness. Banks have those papers. If those papers are cut in half in value, or maybe even deeper, then the banks register losses. They have to be prepared to absorb those losses. How? Well, if they have a good capital buffer. But European banks have well, unimpressive capital buffers, let's put it this way. So there is a pressure on them to increase those capitals. And the banks somehow are not enthusiastic. Why so? Well, because it's costly. It could dilute the current share ownership. So it's against the interests of the current owners and the current managers. So, well, at some point, if this happens, some of those banks can be sort of forced to be recapitalized. The Brits didn't hesitate, they just nationalized their banks. We don't like the Americans hate to nationalize banks. The Europeans don't like it. But if necessary, they will do it. So these are the three options, how to solve the crisis. The muddling through does not guarantee success, but it's something that is politically least unviable, so to say. What about the private sector involvement? Well, the banks obviously would love to have the debt of Greece, Ireland, and other countries to be monetized simply, bought out by the European Central Bank at par value, so that the banks would be spared any losses, and well, central bank would be recapitalized at some point, which is another way of basically spending money on Greece, but in a way that is politically probably least sensitive, because nobody really knows how this could be. Maybe the only exception is the Dutch parliament. They know that this kind of, trickery is a real money transfer from good behaving, good performing countries to bad performing countries. Again, the central bankers, European Central Bank, and Jean-Claude Trichet himself does not want private sector involvement. But why? Because he said, well, contagion. If the banks take losses or are forced to take part of the burden, then they would immediately withdraw funding to other countries. Why should they keep borrowing to Italy? That's an important issue. And here it would be fair for the banks to share the burden. After all, it was the banks who made a splendid business on this, and they were reckless in basically not recognizing the difference between Germany and Greece in the run-up to the crisis. So they should be paid. They should pay for it. That's fine, but let's forget about fairness, about honesty. That's not something that really is well. It is important. It is important politically, but instantaneously, the danger is that the banks will simply stop borrowing money to other countries which are in need also. And it's not only about Italy, it's also about France maybe. So this is this is the obstacle to having banks pay their share. Global currency. No, I don't think you cannot. I mean, the institution of global or reserve currency is a market phenomenon. It's not something that you can sort of impose on the global economy. It has developed in a process. 100 years ago, it was the British pound. The British lost their significance in the economy. It became the US dollar, and now it's basically a multi-currency system. About 30-something% of the global reserves are held in euro. So euro became a global currency also, a second currency. There is also a smaller role played by others, like yen, like Swiss franc, like the commodity currencies recently, like the Australian dollar, the Canadian dollar, even Norwegian krona. Why not yen? An obvious candidate. Well, yes, it will come as one of the global currencies. The problem is that the Chinese are not prepared to allow yen to be traded freely on the global currency, or the global market. I mean, for a currency to be accepted as a reserve currency, for example, if as a central bank governor of Poland, we would like to invest in yen papers, in yens, not in yens, in yuans, in renminbi. Well, we would have to have access to those, which means that the Chinese would have to lift the capital controls. They would first have to allow us to invest in renminbi or in yuan. Then we would like this renminbi papers to be liquid, which means easily sellable and on the market, because then it doesn't make sense to have reserves in something that we are stuck into and not be able to sell. And second, of course, this entails obviously that the Chinese currency would be allowed to float on the market, and this is what the Chinese are not prepared to do. So this is a problem. It will take some time for the yuan, for renminbi to be one of the currencies, but this is on the side of the Chinese. Everybody would like to invest in yuan, but it's simply not possible. Forget about all those grand plans to institute, like SDRs, or like an artificial currency produced by the IMF, because you have to have a liquid market. If Poland has SDR holdings at the IMF. Suppose that we would like to draw on those SDR, special drawing rights. It's the name, SDR. As did Ukraine in the wake of the crisis in 2009. Well, they were allowed to draw on their holdings of SDRs at the IMF, but they had to find a buyer. They found a buyer. I'm not allowed to say who the buyer was, but it was really a credit extended, or not a credit, just a grant that was extended by that country to Ukraine at that time. How can it serve as a global currency if you have to have a market? You have to have a market maker. Who would be the market maker of this? Nonsense. So it will take some time, and the global currency will be a multi-currency. It's going to be a basket with increasing role of the Chinese currency, but it will take time. The Chinese have to free the yuan, and then it will become one of the most respected currencies in the world. Now the question that you asked about what is the situation of a country like Poland and a currency like Polish currency in such a turmoil? Well, first, this is one of the consequences of not being in the Eurozone. I mean, when you are in the Eurozone, then you suffer from different other diseases. But when you're out of the Eurozone, especially in a country like Poland, with a deep exchange rate market, złoty is fluctuating. You're from Czech Republic? You're from Poland? Yep. Okay, your accent is Czech. I'm so sorry. But the Czechs are so let's forget about the Czech Republic for the moment. No, it's a very interesting case. But złoty is fluctuating wildly, not just widely, wildly. Sometimes it's very beneficial. In 2008-9, zloty depreciated and basically protected Polish exporters from a slump. It may be the case also now. The slowdown is coming, so zloty is weakening. It may also be beneficial for the exporters. However, what we are seeing at the markets are different things. First, well, there is basically I called it, I mean, the financial market is a nut house, simply. I mean, we are not really thinking of rational, longer-term motivations. It's just how to basically survive the next month or the next quarter at best. So what we have observed in the last few weeks is that people were selling emerging market currencies and were buying into dollars because it is perceived to be safe. Well, sorry, to me it's nonsense. I mean, if I were an investor, I would prefer, okay, I would prefer Deutschmarks. There are no Deutschmarks, so I could probably buy Swiss francs. Well, there are no Swiss francs available anymore, or basically the game is over, at least for the moment. So if I buy Brazilian bonds, they would almost certainly gain in value. If I buy American bonds, they will almost certainly lose in value. Of course, because the interest rate sooner or later will go up, and the bonds, the US bonds, the US Treasury bonds will lose value. That's so obvious that I mean, but you have to have patience. It will happen not immediately. It will happen in years rather in months. But the investors think about the next month or the next quarter. They would like to show a good result to their bosses or to their shareholders, otherwise they would be fired. So that is why you have this flight to, okay, safety. I mean, what kind of safety it is? Second, they have recorded losses. For example, well, those who are bondholders of Italian government, they have recorded losses, of course. So they have to compensate this in recording gains in other markets. So what you have observed maybe recently, which is a folly, but it's not, that the price of gold fell. I would have expected in a situation like this that the gold would, the price of gold would go through the roof. No, because the people who have lost money on Italian bonds, they want to recover those losses. And what they can do is to sell gold certificates, because gold they have bought at, say, $1,300 per ounce, and now it's $1,900 or $1,800. So every ounce you sell, you gain immediately. And the same goes for zloty. On top of these, we have seen, however, certain features of pure speculation. If you don't tell there are instruments on the market that you can basically drive the exchange rate of the zloty to any level you want. Just forget about the fundamentals, about the economy. You can do everything with a small currency. Unless there is a warning that you can burn your fingers. If you go too fast, you can lose money. Well, this is what we did on Friday. We intervened on the market, and now some of the guys in those desks in investment funds, hedge funds or investment banks, know that they lose money. They can lose money. And they can lose jobs, because their bosses will immediately fire them. That's the jungle that we are discussing. So this is why we intervened on the market. Of course, we are not defending any exchange rate, but the signal we wanted to send is, okay, be war. it's at random. We can do it any moment. But we are not forced to do it. We are not defending any exchange rate. As a matter of fact, weaker zloty is good for the economy, at least from some point of view, not for central bankers, because we hate weak zloty because it feeds inflation. But this is why we did it. I don't know whether it will be 100% effective, whether it will stabilize the market, but at least the first few days, today also, I don't know what has happened to zloty, but throughout the day it was quite stable. So those guys who were in the business of speculating against the zloty have probably lost so much money that they are not now a bit, cautious. This is what we wanted them to know. That it's a two-way street. It's not a one-way street. The difference is that when you overtake cars on a two-way street, then you can, in the last moment, you can realize that there is a big truck going and crash.
Agree with Jacques Delors, who always said that a monetary union without an economic union was like somebody walking with one leg and limp along. So my question to you is, how do you see what should be done to have an economic government, or what they call economic governance, whether it is enough to say that from now on, every 6 months, the President of the European Council, for the 27, will also preside over the European heads of state of the 17. Is that a solution? I would like to know what you think of Eurobonds. Do we need them now, or does every budget have to be balanced before we go into it? And the last part, the golden rule, which is a balanced budget. Do you want this to be in every constitution?
Well, the first country to have this golden rule is Poland, not Germany. We have instituted this rule into the constitution in 1997, and it's working pretty well. But coming back to your main questions, yes, I believe that tertium non datur, as a matter of fact. You either want to have a common currency or not. If you want to have a common currency, you have to decide on something which is not necessarily a state or even a federation, but something that moves into the direction of a European state. So, for example, the main issue here, and you have mentioned this as a last solution, is this common bond, Eurobond. But Eurobond is basically a state. It's an attribute of a state. If you issue a Eurobond, which is a bond that is satisfying borrowing needs of all the countries of the Eurozone, this means guaranteed by everyone. It means that you must have a tightly coordinated fiscal policy. You must have sort of a joint management, debt management. You must have you can call the institution finance minister, or if it's unacceptable for others, you can call it enhanced whatever fiscal coordination. But the Europeans are very good in finding names that do not mean anything. But I mean, if it helps solve the problem, why not? But really, what it means that, say, Poland, if it joins it, and it's now not the matter because we are not in the Eurozone, a country could decide on the structure of its budget, but not on the size of its budget. What is biting here, and it's sort of idiosyncratic preference of France, is the issue of tax harmonization. Tax harmonization is something very unpopular in Poland because we boast of having low taxes, although the polls say that we have the highest taxation. But when it comes to tax harmonization, suddenly we turn, oh my God, but why should we agree to those high taxes abroad? I don't think that that the issue is uniformization of tax rates. The issue is of uniformization or at least bringing into some proximity the rules the taxable income is calculated. Well, Ireland may be a loser on this account, but not Poland, because when you look at the budget numbers, the overall corporate income tax burden in Poland is higher than in most West European countries. Because, yes, we have lower rates, 19, and in many countries it's 35, even higher, but the way you calculate the taxable income is very lenient, very liberal in most countries in Western Europe. Whether it's quite rigid in Poland. So if you put this make it uniform, then it may turn out that taxes are not so low in Poland after all. Well, the other country that could be very unhappy is Estonia, because they have basically done away with the corporate income tax. But yeah, the question is, if you are serious about euro, you have to build up something of a state. Well, for a country like Poland, this is a dilemma, because on the one hand, we scream about this Europe of two speeds, two-speed Europe. But I'd say I prefer a two-speed Europe than a Europe without any speed, or a collapsing Europe. And this seems to be a choice. So if they want to build up a state, why not? And two-speed does not necessarily mean that this inner circle will move faster than we. On the contrary, the countries outside of Euro are very diversified now. The UK is basically stagnant economy. Denmark is another stagnant economy. Sweden is growing fantastic. Poland is growing not bad at all. So you have good performers and bad performers in outside of the Eurozone. It's not the matter that really decides. It's not the decisive factor. Well, when the euro survives the crisis, it emerges from the crisis strong and attractive. We'll have the dilemma. I mean, a country like Poland, either to join a heavily, tightly integrated area which has some attributes of a state, or serious attributes of the state, or not. And I don't know what will be the decision, but I think that when you look at the map, at the statistics, Poland is a natural member of the core of Europe. So is Denmark, Sweden, but not the UK. So this is my guess.
Let me take a couple of suggestions. You ended your very eloquent talk with a picture of the Leaning Tower of Pisa. Beautiful aesthetic choice. I imagine it's something more than an aesthetic choice as well, because if Italy comes under attack and has to default, that I take it would really be beyond the capacity of the other Euro states to rescue. So I have a couple of questions about that. First of all, how close do you think Europe is to the possibility of bankruptcy? And
To
a possibility of having to default? And secondly, it's become quite clear that the Italian government is not doing enough to cut expenditure and so on, and in particular that perhaps the Italian Prime Minister doesn't seem quite concerned enough about that situation. At what point do you think would be legitimate, or perhaps necessary, for the other Euro states to threaten to stop buying Italian debt unless Italy becomes serious and possibly unless there's a government change?
I'm not able to assign any probability to any outcome. Let me just say the following, that yes, you're right, there is no money in the world that can save Italy. Italians must save themselves. But you know, when you look at Italy, you have to notice two things. Number one, Italy is an over-regulated economy, basically paralyzing, stifling competition. Occupations are still you know, closed. The whole story. But fiscal policy, I mean, current fiscal policy is pretty okay. They have a sizable primary budget surplus, which means that the fiscal sustainability is not worsening, it's getting better. It's getting better slower than we would like to. But I don't want to say that Italy is in a situation that is anywhere close to the situation of you know, Greece, for example. Second, well, 70% of Greek debt was in the hands of foreigners. In Italy, I don't know if it's 80% or 85%, but it's vast majority. Italy is more like Japan in this respect. So so the problem of Italy is, of course, that they have to continue fiscal consolidation. Yes, they want even more. They need sort of liberalization of internal liberalization of the economy. But what is really crucial for this country is to bring back stability to the financial market, so that the markets stop thinking in terms of next month, but look at the country with a longer perspective, sort of with cool eyes. And I think that Italy is I mean, can do it. It's not a problem. Well, you have also mentioned the illustrious Prime Minister of Italy. I'm not in a business of you know, ranking the leaders of European countries, but I think that Italy needs such a change. That's for sure. You know, the problems that Berlusconi has basically cripple the government. And let him do what he's good at Sardinia.
Essentially, you've shown us that Poland is a sort of virtuous economic actor, both in terms of fiscal policy, but obviously economic policies. But what do you attribute, you know, if you look inside Poland, what have been the keys to this relatively successful performance? 5-10 years ago, one looked at young Poles emigrating outward to the rest of Western Europe, and today it's changed. So I'm just curious where the well springs of this recovery or this virtue come from. And I do wonder whether in a European Union, which allows for immigration as a buffer all the time to labor policies, should the costs of the European Union, in a sense, or the euro, since Poland or all these countries that can send immigrants to the eurozone, are they in some sense free riding in any sense?
Well, first about, I mean, I'm not here. I haven't come to describe and elaborate on the weaknesses of the Polish economy. There are many, but you know, I have come with a completely different purpose. I would rather tell good things about it, which I did. But if you're asking me about the source of relative strengths of Polish economy, it's entrepreneurial class. What we managed to build up in this last 20 years is to build up a sort of domestic, indigenous entrepreneurial class. Let me give you an example of how it works. If you look at the Polish exports to the European Union, basically, well, compared to the GDP, this is about half of what it is in the case of the Czech Republic. I confront Poland with the Czech Republic because this is the best managed, the most mature economy in the region. I mean, really something that I mean they should be proud of. I mean, Bohemia was the second most developed region in pre-war Europe, so it's not a miracle. It's just they are back in where they belong. But if you look at exports of the Czech Republic or Slovakia, two very successful countries, most of these, like 80%, are exports in, I mean, part of global distribution channels. So these are companies that are part of global network, either owned by, it's a Skoda that is owned by Volkswagen, but it's also the suppliers, the immediate suppliers to the international distribution networks. And they are there because of high quality of labor and low cost of labor. In Poland, 45%, slightly less than 50%, but it's growing, of exports are produced by domestic companies. And they are not parts of global distribution channels, networks. They are either producing final goods, consumer goods, or more and more frequently investment goods, but they are sort of standalone Polish companies. As a rule, established in the last 20 years, this is the new entrepreneurial class. I mean, simplifying this, these are the Polish food products, or the Polish garment, or the Polish construction materials. Nobody knows in Europe that the second biggest producer of windows, those windows, but okay, the roof windows, which is very popular, is Polish. Nobody knows, but it's growing fast, and it's basically trying to overtake the #1 producer, which happens to be Danish, and they are in. Everybody who is interested knows about it because the two companies are in many legal disputes, of course. Because when it comes to monopoly, then you have reasons to lead legal disputes. So, if almost half of Polish exports are produced by Polish producers, by Polish companies, this is a good evidence of what kind of progress has been made by those companies in the last 20 years. They are, as a rule, not older than 15 years. This is basically the engine of growth of the Polish economy. And it didn't, it's not a miracle. It's a conscious policy of Polish authorities. Contrary to what you hear from the Polish entrepreneurs, Polish companies enjoy extraordinary privileges in Poland. First, they pay low taxes, low flat taxes, both personal income taxes and corporate income taxes. It's a linear tax of 19%. Don't be fooled into those guys who say that Poland is the only country that does not have a flat tax. It does not have a flat tax for 2% of professionals who have to pay 32%. Everybody that declares that he's an entrepreneur, even self-employed, is entitled to pay 19%. Low taxation, low taxation. Maybe not lower than in the Slovakia or in Estonia, but it's still low. Second, Social Security contributions are levied on the minimum wage if you are self-employed. So you may earn $10,000 a month, but you pay Social Security contributions on $500, the lowest. This is obviously treated as a normal state of affairs in Poland. Nobody even thinks that it is a privilege, but it is. I can see how my son sort of tries his luck in business, how easily it is for him to sort of set up businesses and I mean, prospers and function. Nobody will tell you. On the contrary, in Poland, the prevailing mood is that it's very difficult to do business in Poland, that it's, we are, you know, like in the index of entrepreneurship behind Botswana and, you know, South Guinea or, you know, North Guinea, whatever. This is all bullshit. This would not have happened. We have produced a vibrant entrepreneurial class, which is obviously lobbying for the next privileges. And I mean, this is without it, we would be much weaker country. I support it, but obviously I rebuke them in open, in public, when I meet them, for the arrogance of their lobbying. But they know that I support them. This is the main answer.
Yes. 2011 Zaleski lecture. Thank you so much, Professor BELKA.